Tell me what's happened here. How could the credit markets stare down, as I say, that 500 basis points? They seem to have just absorbed it and gone on.
How about the equity markets up 15%?
Also true.
So look, the markets are up because the economy is doing better than people expected. And the big adjustment has been that inflation hasn't gone away, and that reversed the market's expectations of 6 Fed cuts down to 1 or 2 this year. And so when you have a resilient economy, it's good for equities, and it's very good for credit too.
And when we talked last time, you were talking about something like $1 trillion in debt that was going to have to be refinanced at a different interest rate than we'd seen before. What happened to that? It doesn't seem to have happened yet. Are they just extending the time? Are they fixing it? What's going on?
So I'd say the biggest development in the markets has been the reopening of the syndicated markets. Again, we as a firm do syndicated markets, private credit, stressed and distressed, and structured credit. And what happened is the cost of financing for what's called CLOs, these collateralized loan obligations, which are the biggest buyers of leveraged loans. It's not the banks who buy leveraged loans, it's the CLOs that buy leveraged loans, 70+%. The cost of financing has come down 50 basis points in the last 6 months. And with that cost coming down, and with a positive economic backdrop, there's been, and with very limited M&A private equity activity, you've had demand pick up because the CLOs have low cost of capital. You've had limited supply of new deals, and guess what happens? Pricing goes up, spreads come down, and you have this very ebullient refinancing market. So there's been a lot of refinancings in the syndicated market, principally because of CLOs. So we've taken a dent out of that wall, but there's still $1 trillion plus of debt coming due, and that's something we're going to have to deal with, and something that we're quite excited about.
So more creativity is going on as well. I hear things about things like liability management exercises or transactions. I hear about payments in kind. Are these ways that creditors are finding to really restructure their capital stack so they don't have to pay the debt?
So let's separate the pieces, because pay in kind, PIK features are something that is 30 plus years old. It is now making a resurgence. I'll come back to that in a minute. Liability management exercises are essentially when companies have debt coming due in 2025, 26, 27, and because of some challenges in the business, because of higher interest costs, there's a sense that maybe they can't refinance at par in a couple of years. And the debt is trading at discounts today. Now, again, the distress ratio, which is a percentage of the high yield market that trades 1,000 basis points over the 10-year treasury, over the relevant treasury, 5-year treasury, is only 6%. So there's not a lot of stressed and distressed debt out there. But where there is, what companies are doing is these so-called liability management exercises, where they're going to the debt holders and say, hey, we'll swap you into something that's coming due, something that was coming due in 26, and we'll ask you to extend your maturity. If the debt might be trading at 60, we'll offer you 80 cents of recovery in something that people perceive to be money good, so they can take their existing paper from 60 to 80. Now, they are leaving 20 cents on the table because they have a par claim. And so the liability management business is a very complex business. It's super exciting. We're incredibly active in it. And I do believe that is the next wave of stressed and distressed credit. On the payment in kind or PIK features, what you're seeing is that you hadn't seen that much PIK issuance. What you're now starting to see, and it's emerging in private credit, is companies are looking at their businesses, and they may buy a business for $2 billion, and it may be a very high growth business, and they want to do $1 billion of debt issuance, and rather than pay out cash interest, they'd rather have the debt accrue in kind. That's not necessarily a bad thing, nor is it necessarily a good thing. If you invest in that company and you believe that company is absolutely worth $2 billion, and you're investing, let's make it 800 million, not $1 billion, and you pick on a small portion, you're compounding at that rate, which today would be in the neighborhood of 10, 11%, and it gives the company extra cash flow. Where PIK is a little bit more concerning is where companies are more challenged and they don't have the cash at all. I think PICs and new deals are really about financing growth as opposed to remedying more challenged situations.
Glenn, tell me about the risks being faced by the people putting money into private credit. We had Jamie Dimon this week sort of come out and say there may be hell to be paid if, in fact, private credit goes south. He seems to think there's a lot of risk. He may be talking his book, I don't know. But what's he talking about?
Look, Jamie always has incredibly interesting things to say. At the same time, Jamie is talking about adding more money in private credit and potentially buying a private credit manager. I think where he's focusing on is that in a market where there's lots of demand, there is sometimes a tendency for people to be too aggressive in underwriting. And there's certainly a number of players out there that are new to private credit and may be willing to be a bit more aggressive. That said, when I think about the underwriting that we and many of our large peers do, and medium-sized peers too, if you have 50+% equity cushion in a deal and you do a reasonable job of underwriting the credit, even if you make some mistakes, you have a lot of cushion. And I'll make a couple points. One is that we did this study and we looked at what does it mean to have 50% equity cushion. So I did a study of the Russell Midcap, which basically has median EBITDA of 150 or so million, kind of right down the fairway of what we do. And I did the analysis asking, how often did a company lose more than 50% of its equity value in 23 years, from 2000? And the answer, 5%. 5% of the time. And that happened in 2001 after 9/11. And the internet bubble bursting. It happened in 2008 from the GFC, and happened in 2022 when growth stocks got hit. And so if you do careful underwriting and you pick good companies, you really should have sufficient cushion. The last thing I'd say in terms of where I think Jamie was going is there's a legitimate question on the accumulation of alternative assets by the retail investor and by the high net worth individual. And there's certainly some concern that Jamie expressed that maybe some of these investors, when and if they go to take their money out and they can't get out or they have losses, that their congressman will get concerned. Again, I think because the amount of cushion is so significant, I think that outcome is less. But for sure, and we have wealth distribution with our products, we want to make sure that the people who are buying our products, just like the institutional investors, understand what they're buying.